All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Let's go out and get to it. Interesting day in the market here today. Now, let's start with the challenge. We have gold on the board here, Barrick Gold, and it's pretty much where it was this morning, so we're up a little bit on it. Challenge just around 4,200 there. And in rolling, Barrick Gold, it's trading right now around 19. Our profit level's 1934, so we do need another push on it. We're coming up on the red stop here this afternoon, but the position's in the green here, so nothing really to worry about with that. And we'll continue to hold on to it. Now we do have a new trigger on the board here this afternoon, and that is with GLD. And we don't see this very often, but we've seen it happen from time to time. We saw it happen with Netflix, a couple weeks apart. But even Walmart here, but switching from bearish to bullish. But GLD was a bullish signal on the 10th and is a bullish signal here again. Now, the only way for that to happen is if we get the bullish signal and then have a small, very small pullback. And that's what we had. And now today getting another fresh 3-7 crossover on it, and consolidation risk is fairly low. According to the algorithm, and so a new signal here. And I looked at the options, and I looked at, do I go and get this? Because let's face it, we already have GOLD for the challenge, right? And GOLD is basically the same thing, right? It's the same thing. So double risk on the same thing. Nah, I'll hold off. I'll wait and see what the next signals bring there with it. And so we'll go from there. So from the challenge standpoint, going to go into the close here today with GOLD and cash, and look to react to any of the next signals that come in. Now, on the upside crossover list, we have the same as what was on here this morning: EOG, Facebook, GLD, Vulcan, Walmart. So nothing really new there. And on the downside crossover list, it's empty. Last I saw, it's empty. So nothing really crossing on down there with the market selling off a little bit here this morning. But overall, market's bounced on back. And if I pull up the S&P futures here, we can see that it is pretty much, futures are pretty much right back where they were yesterday at the close, right? So a very kind of reactionary dip, and we're starting to see, or we've seen kind of it's just steady grind back the rest of the day. Now, it's not been a steady grind back for everything, right? There are definitely pockets of strength out there and pockets of weakness, and it's very differential in terms of how things are moving. Even when you look like in the tech group, right? You see Adobe in the green, you see Microsoft in the red, you see Apple in the green, you see Google, or you see Apple in the red, Google in the green. You have a lot of discrepancies out there, and it's generally just a sign of more just fund manager action rather than algorithmic, just all in or all out type of stuff there. So anyway, that's kind of a little bit of what we've seen. Now, it's one of those where I've been asked, this coronavirus, and does the market ultimately discount it? Does the market ultimately look and say, hey, coronavirus is real, the threat is real? Because when you go out there, right? I mean, you don't have to go look very far. There's a lot of fear out there, from some of the health officials and whatnot about what could happen in regards to the coronavirus. And the reality is simple. The market has discounted it basically with 3 days of selling, right? We had this reversal day right back here in January. We had the gap down, and then we had the kind of 3 days later a hard sell. That's it. That's really all the coronavirus selling has amounted to. And you think about it, well, wait a minute, coronavirus, we have France talking about it taking a full point off of global GDP, and stocks are still on the rise, right? It doesn't make logical sense in in the context of normal market parameters. But we've talked about the reasons why, we could still see markets go up is because, look, I mean, there isn't much from an alternative standpoint, right? It's not like fund managers can go out and get a whole lot in bonds, and so they're kind of stuck in stocks a little bit here. But the market's dealing with something else right now as well. And that is a sizable shift in currency. And what do I mean? Well, take a look at the euro. And this is a monthly chart of the euro. The euro here since 2018 has been falling. And you can see even over the last 2 months, to start 2020, the euro has been dropping and dropping substantially. Right, we are seeing a fairly large move here, and one where when the euro is moving down like this, what's the U.S. dollar doing? Well, the U.S. dollar is moving up, right? And we see the U.S. dollar moving on up here. So we have this erosion in the euro, and one of the things that we tend to see when the euro erodes is that we tend to see gold move on up, right? I'll reset this chart. My apologies. XEU. My apologies there. But we tend to see gold move down with the euro and move up with the euro. Gold and the euro historically are highly correlated. So let's go take a look at that here. And I'm just going to put on a correlation indicator here to this. And we'll go and just correlate this to the raw price of gold. And what you'll see is that historically, for the most part, our correlation is up here around 1. Now, what does 1 mean? 1 means that if the euro goes up, gold goes up. If the euro goes down, gold goes down. It means they're positively correlated. They tend to move in the same direction. But here in 2014, we saw something that we had only seen, 2 other times, and they were very brief stints, but we saw, the euro and gold become uncorrelated. In fact, became negatively correlated to where when the euro was up, gold was down, vice versa. But that didn't last very long, and it went back into this positive correlation. But last year, we saw the correlation between gold and the euro switch in a way that we haven't seen pretty much ever, right? Let's see how far we can go back on this chart, but let's see here. I'll go back 20 years. We can go back further, but even just 20 years, you can see this is the biggest negative correlation that we have seen between gold and the euro in 20 years. Let's see if we can go back a little bit further here, 1980. We'll see what if they have the data here. All right, it's going to let us go back to 1993. But this is the most negatively correlated that gold and the euro have been, right? And so what do we see? Well, we see something very unusual. We see the euro making new lows while gold is making or close to new highs here. I mean, gold is at fresh new highs for the short run, and looking to chase down its 2011, 2012 price targets. And you say, okay, that's reasonable. We see that, but that means the U.S. dollar has to be going down, right? No, the U.S. dollar's been going up. U.S. dollar has been on the rise here, and that is something that is highly unusual. It is something where, the last time we saw gold up at the current levels, the dollar was down here, back here in 2011, 2012. Now, the dollar has appreciated by almost 30% in value, and gold, it took an initial hit, but it's come all the way back. So what's going on? Well, we're seeing a seismic shift in this historical relationship, and it is one where there are a lot of ideas and a lot of theories out there about it, but it's one where we saw last year, you cannot take and go, oh, well, U.S. dollar, this is what it's looking like, so this is what's going to happen to gold the way you used to. You just simply can't look at that euro dollar relationship and equate it to gold the same way as have been able to do historically, and it's one of those where I like when there are nice relationships like that, but this one is gone right now. Will it ultimately come back? Probably, right? And there are some interesting arguments for why it's decoupled and why it's not in the same relationship. But one of the biggest arguments is the U.S. economy has grown faster than the European economy, and that's not even an argument; that's a fact, right? And so we've seen the dollar go up and the euro go down. And we've seen that happen historically, and gold has gone down with it. But right now, it is just a little bit of a different ball game. I do believe that some of that is just simply due to the lack of bond options, right? When it comes to bonds, it's not like investors can jump on in here and get paid a whole lot. So if they're gonna, instead of buying a 10-year U.S. Treasury, which has just been trashed, they'll go out and say, well, you know what, if I'm not going to make anything, at least I'll hold a hard asset like gold and go from there. That's one argument that's out there, but, gold isn't exactly liquid. It's not exactly something that's, big money can really buy in and sell out in a huge way the way they do in bonds and in stocks. And, there are a lot of other, tangent reasons out there that people throw out. There's not one that I totally buy, that I look at and go, oh, of course it's that. There are some things where you just, okay, sure. But bottom line, if you're going to be involved in gold or the euro or the dollar, you just can't look at those relationships anymore. You have to trade what you see happening with that specific commodity or currency. I guess all three of these really are simply currencies. And so if you're going to go out and trade gold, you trade gold for gold. You don't sit there and trade gold and use euro dollar hedging and things like that, the way you used to be able with that. We've talked about gold a lot since last year, and the fact that gold broke out of a long-term consolidation. Here's the weekly chart to kind of zoom in on it, but this was a many-year consolidation, right, going back many years, and it busted on out here last summer and, been very bullish ever since. Yeah, it had a little pullback in September, October, November, but ended the year very strongly last year. And you'll notice stocks went up at the same time, right? So this isn't even something where you look and go, well, you know what, gold goes up when stocks go down and vice versa. No, gold's hitting new highs with stocks hitting new highs, right? And, it remains one of the most bullish long-term charts that is out there. And I'm not historically a gold bug, just bullish on gold all the time. But when we look at the technical elements of gold, we look at the consolidation that we've seen within the mining industry, and the supply-demand components there. It's just one of those things where, could we see gold double from here in the next 2 years? Yeah, we could. That's not out of the realm of possibilities, and something that does have to be watched for. So I don't like gold as a hedge, meaning if you're going to buy a bunch of stocks and then go buy gold to hedge them, I don't think that makes a whole lot of sense. I don't think this is a hedge story at all. Gold is its own story, and I guess that's my final point with this all. Gold is not a stock story. It's not a dollar story. It's not a euro story. It's not a fear story, the way that it's always been, right? It is its own story right now with its own dynamics and its own supply demand, pushing the pricing. And it needs to be treated as such rather than as a subset of stocks or a subset of currencies there. All right. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow. Take care.